Welcome to Chapter 6, Common Stocks. This is part 2 in a two-part series. So we're going to continue here with common stock dividends. So not only do stocks have the exciting appeal of capital gains, but also many stocks today pay a decent dividend income. So it's one of the two sources of income that you can receive by owning stocks. And dividends can actually represent a significant part of the return stocks can deliver over long periods of time. Now, dividends is a way for a company to return profits to their owners. So as an owner, you're entitled to part of the profits if the company decides to issue you a dividend. Now, so if companies have retained earnings, they can decide to use that money to reinvest it in the company, grow the company, or buy another company. But if they feel like there's no good investments to make right now, they can take that money, the profits that they've made, and instead pay them out to you as a form of a dividend. Dividend, depending on the stock, dividend income can be predictable source of income from a share price of stock. In some stocks, the dividends are very predictable. Some dividends have been paid over many years. Some dividends grow. Some dividends remain the same. Now, as far as investors, there's advantages and disadvantages to dividends that we're going to be talking about over these next 9 slides or so. Now, the current tax laws in the U.S. Put dividends in the same tax advantage as capital gains. So they're both taxed at a similar rate. Now, tax laws are changing all the time, and depending on how much money you make and different stocks, their dividends can be classified in different ways. So you really would need to check with whatever the current tax laws are, what the current stock, what laws they fall under, such as, for example, a real estate investment trust that's issued as shares of stock would have different tax laws in their dividends than ordinary dividends paid by an ordinary company. And of course, depending on what country you're living in, different countries have different laws on how dividends are taxed. So we're going to talk about a few things here about the dividend decision, types of dividends, dividend reinvestment plans. So let's start with the dividend decision. Who makes this decision? Well, it's the board of directors who are going to look at the company and they're going to say, okay, we have enough money, financial conditions are good, let's pay out a dividend to reward the shareholders. So a dividend, I always look at a dividend like a reward to shareholders for sticking with the company, and when the company is finally profitable, they want to return some of that money to the shareholders. Now, there are both, corporate and market factors in play when deciding to make dividends. So one thing that you have to remember, if a company pays you a dividend, say the stock is at $10 per share, and they announce a $1 dividend that they're going to pay, that's going to affect the stock price. And when the dividend is actually paid, the stock price will go down in relationship to the dividend being paid. So if your company's going to pay a $1 dividend, once that is acknowledged and paid, the stock price will typically go down $1 to reflect that the company no longer has $1 worth of valuation to pay it out to shareholders. Now, typically, when companies do pay dividends, their shareholder price recovers pretty quickly. So it's usually just a temporary downward movement in the stock price, and usually returns to that same stock price or greater before the next dividend payment. Now, if we look at earnings per share on the corporate side, earnings per share is the amount of earnings tied to one share of stock. So dividends are typically paid out of these earnings per share. Now, how do you calculate earnings per share? Simply, it's your net profits after taxes divided by the number of outstanding shares. In some cases, some companies may have preferred dividend responsibilities, so those have to be paid out of net profits before you can divide by the outstanding common stock. In many cases, companies may not have a preferred dividend at all. So if you ever have to calculate this and you see that there's no preferred dividends listed, that's fine. Just take the net profits and divide by the amount of common shares outstanding to get the earnings per share. So typically, the dividends typically don't exceed the earnings per share. Now, let's look at these corporate versus market factors. So from a corporate standpoint, we're going to look at the growth prospects. How much of the earnings that a company generates do they need to continue to grow the company and take advantage of opportunities? How strong is the cash position of the company? Can the company afford to pay a dividend from cash? Because that would reduce cash. Does it have enough cash to pay the dividend? And then loan agreements. Certain loans will have restrictions on dividends that can be paid if the loans aren't paid back first. So it may limit the amount. And this is to prevent a company from, saying, borrowing $10 million and then taking all that money and paying it as a dividend to shareholders and then going bankrupt. So if, say, you had a company that had no real prospects and you got a bank to lend you $10 million and you own 80% of the stock, you have 80% ownership, you pay out that $10 million in dividends, you now have that $8 million earnings or dividend cash to yourself. Company goes bankrupt, the bankrupt company doesn't have to pay back the loan. So this is why these loan agreements usually have a caveat to limit dividends. From the market point of view, can the firm justify to investors that retaining the earnings is a better investment than paying the earnings out? So is it better to pay a dividend and let investors reinvest that in the stock or a different stock, or keep it as cash? Or is it better for the company to retain their earnings and make the investments, which will grow the profits faster or the stock price faster? Typically, most stockholders are fine with the company retaining their earnings, not paying a dividend, and continuing to grow the company if the company is in a fast-growing marketplace or industry. If the company is in a very slow-growing industry or doesn't have the ability to grow like certain utilities, then the investor may prefer that the profits be paid back as dividends. And also, what are the dividend expectations of your shareholders? Some shareholders buy a stock knowing full well that this stock is well known for paying dividends. And some investors buy growth stocks not expecting any dividends, or disappointed if the company pays dividends. Because remember, if a company pays dividends, then the shareholders have to pay tax on those dividends. If the company retains the profits and reinvests it in the company, then shareholders don't have to pay tax on that utilization of cash. Okay. Now, there are some important dates to know as far as dividends. When a company does make the decision to pay a dividend, the dividend is going to be declared. So there's certain dates that are going to be associated. So the date of record is the date at which the investor must be a registered shareholder to receive the dividend. The payment date, of course, is the actual date which the dividend will be paid. And the ex-dividend date indicates when you're officially a shareholder and eligible to receive the declared dividend. So stocks can sell without the dividend for 3 business days, up to and including the date of record, because of the traditional timing it needs to make all these recording of all these records. So it looks a little easier to understand on the calendar. So the company first declares the dividend. It says that we're going to declare a dividend, and we're going to pay it on the 30th of July. Then there's going to be a point where there's an ex-dividend day and a date of record. So these are dates that you must make sure you own the stock on the ex-dividend date, and then when the stock trades after the date of record. So if you buy the stock on the 17th, you don't receive the dividend. If you buy the stock on the 11th or the 12th, you're going to receive the dividend. So certainly, if you buy and hold the stock. So if you buy the stock on any date, from the 28th up until the 11th, and you hold that stock past the ex-dividend date, you are going to receive that dividend. But buying the dividend after the ex-dividend date, say on the 26th, you're not going to receive the dividend. So it's just a matter of timing. So there are plenty of novice investors who see a company is going to be paying a dividend on the 30th and try to buy it on the 27th, and then they're surprised when they don't get paid a dividend on the 30th because they've passed the date of record and the ex-dividend date. So typically, if you own a stock long term and you're not buying and selling the stock, you don't got to worry about these dates. But if you're going to buy a stock specifically because they're declaring a large dividend, you want to own it before the ex-dividend date. Now, if a company does declare a large dividend, usually the stock price goes up in a similar amount to that dividend. So if they declare a $1 dividend, the stock will go up typically by $1. And when the dividend breaks away from the ownership of the stock by the ex-dividend date, then typically the stock price goes down to reflect that the stock can no longer pay the dividend. So then there are two types of dividends. One is the cash dividend. That's the most popular. And this is when the company pays out a dividend in the form of cash. You actually get cash in your account. They can pay a stock dividend, which is sort of like a mini stock split, where they actually pay you in the form of new shares of stock. So they may give you, for every 10 shares of stock you own, they may give you a 1 share stock dividend. But like a stock split, the stock price is going to be adjusted for that 1 stock dividend share, and you just really aren't getting more money. You're just getting more shares of stock at a lower price. And this could happen too if they do a stock spin-off. This is common for a stock spin-off. So if the company is going to spin off a stock, you're going to retain shares of stock in the current company and have new shares of stock as a stock dividend in the new company. But the two shares together will usually equal the price of the stock when it was one company together. So of course, cash dividends are the most common. And if the company continues to grow their earnings, company continues to grow their profitability and their sales, then typically dividends will grow. And that, in turn, as dividends grow, stock prices grow. As investors get excited about the company's growing financial strength. Two common calculations you can make with dividends is you can make, of course, a dividend yield, which is simply the total dividends paid per share, usually in an annual sense, divided by the current stock price. And that will give you a yield, a percentage. So if a stock is going to pay, a $20 stock pays a $1 dividend, that's going to be a 5% yield. Now, a dividend payout looks at dividends per share versus earnings per share. So if a stock has $1 dividend per share and the earnings per share are $5 per share earnings, that's a 20% payout. It's just calculating the percentage of earnings paid as dividends. Now, when we go back to the stock dividends, when you actually, get stock, it means the firm's going to give you more shares of stock. So a 10% stock dividend would mean you receive 1 share of stock for every 10 shares you own. Now, this will lead to the decline. The share price is about 10%. So again, you may have more shares of, look at your account, you may have more shares of stock, but you have the same money value in your account because like a stock split, you're not really getting any additional money. You're just getting additional shares at a lower price. And what's nice about stock dividends, you're not taxed on stock dividends, just like you're not taxed on stock splits, because you're really not getting any cash or any monetary value. You're just getting a reformulation of the amount of shares to the share price. But whenever you do sell the stock, you would have to pay taxes if you had a capital gain. Now, there are these plans called DRIP plans, Dividend Reinvestment plans. Now, these are a little bit different. So with these plans, you basically would buy a stock directly from a company, which is a rarity because most stocks you have to buy through a broker. But you can, if you're in a dividend reinvestment plan, when the company pays dividends, they basically reinvest your dividends and give you more shares of stock. So there are many companies that offer these dividend reinvestment plans, and they're just a convenient way to make a long-term investment. So if you buy into a dividend reinvestment, you're basically telling the company that I'm going to buy 1,000 shares from you, and you buy it directly from the company in most cases, and then they're going to go in turn, anytime they pay a dividend, they're going to automatically take that money and buy new shares of stock for you. So there's no brokerage fees because you don't deal with a brokerage here. You buy the company. This is the only real chance you get to buy the stock directly from the company. And it allows the company to break the shares of stock up into smaller pieces and reinvest the dividends over time. Now, of course, if you have a brokerage account, you can always set the brokerage account to reinvest any dividends that are paid to you, and the brokerage can do that too. But this would be something where you're directly tied to the company and you're not going through a broker. So again, this was a way to develop some loyalty with companies so that you could have more of a direct connection. But one downside of these dividend reinvestment plans is that there's a lot of paperwork. So if you own 10 companies in a brokerage, the brokerage will give you one tax statement. The brokerage will, take care of everything in one account. If you own 10 separate dividend reinvestment plans, that means you're getting 10 separate tax records from 10 separate companies. It just becomes like a logistical nightmare. But these dividend reinvestment plans were popular when commissions on stocks were very high. It used to be that it wasn't uncommon. If you traded a stock, you'd have to pay a $100 commission. So this was one way. And if you wanted to buy more stock later on, you'd have to pay the $100 commission again. So these dividend reinvestment plans were popular when commissions were high and people wanted to buy stock at a low cost. This was really your only option to buy stocks with no brokerage fees. And sometimes companies would give additional incentives of giving you a discount when you bought new shares of stock in their dividend reinvestment plan. So they could sell you shares of stock at, with a 5% off the current stock price. And the reason they're able to do this is because the companies are actually selling you their treasury stock. They're not reselling you shares from the secondary market. They're using their own stock to sell to you directly. So that means that, the company would receive your funds directly to the company. So it was very beneficial for companies to have these dividend reinvestment plans because it was another way of raising cash by selling stock directly to investors. So this is a good question to ask. Should you keep the cash from the dividend or reinvest the dividend in the company? So here in this slide, we have a situation where you buy 100 shares of stock at $25 a share. So the total investment is $2,500. The company currently pays $1 per share annual dividend, and the price of the stock increases 8% per year, and dividends grow at 5% per year. So let's look at, you just take the cash and the dividends in cash and you don't reinvest. So as you own 100 shares, and this would be investment period from 5 to 20 years, and so these are the dividends that you're going to receive in cash. And then the total dividends received. They said that backward. These are the total cash dividends received each of the periods. And this would be the total market value. This is the market value of the stock here. So by the end of the year 20, you're going to have $11,000 in stock, and you would have received $3,300 in dividends. Now, if you were to make 100% reinvestment, basically taking the dividends and buying more shares of stock, you start seeing the stock price go up. From 115, by the time 20 years go by, you now have 176 shares of stock, which gives you about $20,000 of market value. No dividends, because you reinvest all the dividends. So at the end of the 20-year period, instead of having this would give you, I think, $1,500, you'd have $20,500 or $5,500 more by continually to reinvest the dividends. So reinvesting the dividends is the way most investors go because it makes sense to help grow the company. So one thing, though, they don't look at is if you receive cash dividends, you have to pay tax on that. So this is assuming that you pay tax out of your own money and reinvest all the cash dividends, but just pay the tax. So they don't reflect the amount of tax that you would pay, but it would be equal to the tax you're paying up here because you're receiving the same amount of, actually receiving more dividends here because you have more shares. So the tax aspect is sort of missing here, but this would be without taxes. Say it was in an IRA or a 401k account where you don't pay taxes on your dividends or your capital gains. This would be a better representation of a tax-free account. Now, so of course the market, moving on to a different topic, let's look at different types and different uses of common stock. So the market is going to have a wide range of different stocks, from very conservative stocks to highly speculative stocks, and the kinds of stock investors seek depends on your investment objective and time frame. So let's talk about types of stocks, investing in foreign stocks, and alternative investment strategies. So we have the blue chips. So where they came up with this term, blue chips, is basically from an old an old casino where the blue chips were the highest valued chips. So the blue chips represent, just like in a casino, chips are no longer blue in casinos. They're all multicolor to prevent counterfeiting. But the blue chips used to represent, like I said, the best, highest dollar value of the chip you could get in a casino. And in blue chip stocks represent the best stocks that you can get in the marketplace. So these are stocks with the longest track records of continuous earnings, the longest track records of paying dividends, just very well-established large companies, McDonald's, Johnson & Johnson, Pfizer, AT&T, Chevron, Intel, Microsoft, companies like this. Now, these stocks are typically considered less risky because they're a lot bigger, they have multiple streams of revenues, and they're looked at as the best stocks to own with the lowest amount of risk. So these are typically, you can think these blue chip stocks are the stocks that live in the S&P 500 or the Dow 30. Now the blue chip stocks typically their capital appreciation of their stock price is slower than growth stocks, but just more stable and less risky. Now income stocks are a classification of stocks that pay income, regular dividends, higher than average dividends. So investors seeking a little bit more security and income, say a retiree, they might look to these income stocks. So the dividends tend to increase regularly over time. Dividends are typically higher, and it's a way of offering potential growth for the company. So if the company can't grow that easily in sales or size, like a utility, they may try to compete more on dividends. And they're going to be a little bit more subject to interest rate risk and change, because if bonds are paying a good deal of yield, people may not want to be involved with income stocks. But typically, when bond yields are low, people look to income stocks to get also the capital appreciation, but the income that the stocks generate. So most of the utilities and energy companies, some food companies fall into this category of reliable income stocks, mostly sought after by retirees. And then there's everyone's favorite, growth stocks. So growth stocks are issued by companies that are experiencing rapid growth in their earnings and sales. So they have some sort of product or market where growth is going to be strong for a long time. And they pay no dividends because they're racing to keep investing into the growth market. And this could include some blue chip stocks, some speculative stocks. It's just really, growth stocks are just stocks that are growing quickly. And it appeals to investors. Investors like growth stocks. Like we were talking about Netflix earlier. Netflix is a growth stock. And any stock that's going to be tapping into a new market or a new modality or disruptive technology that's going to be growing, and it's going to be funneling all their money back into the company or borrowing money to quickly take advantage of their opportunities, those are a growth stock. They're riskier. Their stock prices are more volatile, but by and large, they're the stocks that are going to have the fastest movement in stock prices over in some cases many years. So if you take like Starbucks was a growth stock for a long time, the stock price growing quickly. Amazon is a growth stock for many years. So the best growth stocks are ones that are going to last 10 or 20 years in the growth phase. And this is the type of stocks that during a bull market will grow your portfolio the fastest. Now, within many growth stocks are technology stocks. So this has always been a very hot sector, technology stocks. People love technology, and technology tends to grow very quickly. So computers, software, semiconductors, computer storage, cloud, software, networking, wireless communications, these are all tech stocks. And they can range from very speculative stocks to very big blue chip stocks to growth-oriented stocks. And many of these stocks are traded on the NASDAQ, and the potential for returns are considerably high because tech is in demand. Tech is useful for productivity, so individuals use tech, companies use tech, and it's just something that, yes, it will have more considerable risk, but in the long term, they have the greatest price appreciation. So if you look at a company like NVIDIA, you'll see an amazing growth of stock price over time. Same thing with Facebook, Google, of course, Apple, So you get this is where mostly what they'd say the sexy companies are these technology companies, because they have such compelling stories and interest in their business. Now, speculative stocks are stocks that may draw you in as a small investor, and these are stocks closest to gambling. So these are just very small types of stocks that have really potential, good future potential, strong possible markets, and when the stock market's in the bull phase and a lot of money is going into the market and a lot of established companies are very high priced, people may get attracted to these sort of get rich quick type of stocks. And, these companies may lack a long history of operations. They may have a short track record of business. They may have a lot of losses potentially. Their stock price can be very unstable with wide swings. They usually pay no dividends, but over time, these growth stocks, some of these growth stocks become blue chip stocks. And if you get in at the speculative side, growth side of these stocks when they're small, and they wound up sort of like Nvidia was a speculative stock for many years before it became, essentially a blue chip tech stock lately. You can strike it quite rich. It will be, quite a beneficial thing to be involved in. So, Nvidia, basically how that got so big is they make computer processors and graphical engines. And what really kicked up their growth phase in the very end is when all these Bitcoin miners started having to buy all this excessive processing power to mine Bitcoins, really turbocharged their stock. So if you get the right, you could buy 20 speculative stocks. You only need one of them to really take off and make it big in the long term to pay for all the other 19 stocks that maybe didn't go anywhere. Okay, there are also cyclical stocks. So these are stocks that are more closely tied to the economy. So they tend to move up and down with business cycles. So cyclical stocks do well when the economy is doing well, and they do poorly when the economy is doing poorly. They tend to do well in the early stage of economic recoveries. So there's the cyclical stocks are ones that help grow the economy. So you could be in construction, in machinery, you could be in just parts of the economy that tend to take off when the economy starts growing again. So if you have construction equipment like Caterpillar, that typically tends to do well when economies are expanding and growing. As soon as the economy starts to contract, they do very poorly. So cyclical stocks are what a lot of investors will move into when the economy starts to move forward and grow, and we're in a bull market, and quickly move out of when it looks like the economy is going to weaken. Now, on the flip side of that, we have defensive stocks. These are stocks that hold their value and do well no matter what the economy is. So these are, they're less susceptible to the swings of the business cycle, and there are things that investors may like because of the stability, or might be a place to put your money in a slow economy to still have some price appreciation. So we're talking about food companies, public utilities, some drug companies, beverage companies, beer and wine makers, large discount markets or stores. The reason is, if the economy goes down, people aren't going to stop eating food. People aren't going to stop taking their medical drugs, their prescription drugs. So there are certain things that, even though the economy slows down, these companies' products are not the first to be cut in an economic downturn. So say like an automobile manufacturer, if there's a recession, maybe people will put off buying a car, but they're not going to put off going to their drugstore to pick up their medications. Now, as far as market cap, when we say market cap, we're talking the size of a stock. So there are large cap stocks. These are stocks that have market capitalization. If you remember, market capitalization is stock price times outstanding shares. So market capitalization is greater than 10 billion. These are considered large cap stocks. Now, there's not that many large cap stocks, but yet they're a minority of stocks out there, but they have about 75% of the total market value in the U.S. And some stocks are passing the $1 trillion mark of valuation. But bigger isn't necessarily better as far as returns. They just happen to be very big stocks. But very big stocks are like the Titanic. They take a long time to turn around if an iceberg's about to hit them. So they're not as nimble. They're not as responsive as smaller stocks. But still, there are some very large stocks that will, they have a considerable amount of financial muscle to keep going and keep growing as a company. Now, the mid-cap stocks are medium-sized companies that are somewhere between $2 billion and $10 billion of capitalization. And these are still stocks that can have good growth, good capital appreciation. They are, still pretty big. $2 billion to $10 billion are not small companies, but they're sort of companies that are just going to exist in this mid-cap phase, but still have many years of good growth and strong earnings ahead of them. And they, in some cases, they're a little bit more nimble and a little bit more responsive and less of a conglomerate, so they can maneuver a little bit better in the changing times. And in many cases, these mid-cap stocks do go on to become large-cap stocks. Now, small-cap stocks are any stocks that are going to be less than $2 billion in capitalization. Generally, most of these small-cap stocks are under $1 billion, may have revenues less than $250 million, and they're just new companies in many cases, or companies that were older companies that are shrinking. So somehow they just fit into this capitalization phase. But there's potential for high returns here if these companies are on a growth track, if they're in the industry or have a product that are likely to be expanded and grow quickly. And hopefully if you get into a small cap stock and you can stay invested while it grows into a mid cap and finally a large cap, you would have made a lot of money in that transition. Now, of course, when you're investing, you want to think of investing in the total global aspect of stocks. You don't want to invest all your money in one country. Having all your money invested in one country is risky. So even though 40% of the world's equity market is in the United States, that's still a lot smaller than it was back in the 70s when it was 2/3 of the world's equity was in the United States. So with the United States becoming a smaller share of the global stock market, it does make sense to have your stocks spread around the globe in many different markets, because some markets are much faster growing, have more potential. They may also have more risks, but overall, increasing your diversification by having a portfolio that includes companies from around the world would probably get you closer to your goal of having the highest amount of returns for the lowest amount of risk. So now if we look at the average annual returns of stock, say for the last 90 or so 120 years or so, from 1900 to 2017, and actually, this graphic's a little behind the times, because if you look even to today, you see that markets have increased quite a bit from 2017 to 2021. So if you look at the United States, and if you look at Denmark, Spain and Sweden, these four countries are around 11.5%. Now, towards the back, we have Canada, Belgium, and Switzerland, and towards the front, Finland, South Africa, and Germany have stronger average gains. Even Italy beats the United States Italy and Germany and France will beat the United States in average stock market returns over the past 120 years. But then again, remember, this is over 120 years of average annualized returns. If you were to look at stock market returns from 1950 to 2020, this mix would be quite different as far as which companies are in the top of returns and which companies are in the back half of returns. Because most of the United States stock market gain occurred in 1950 to 2000. So that is not really taken into account here. But this is something that's just interesting to kind of note and show that different countries have different annualized returns, and having a basket of these countries represented in your portfolio would increase diversification and steady your returns. Now, how to invest in foreign stocks? There are different approaches. You can do the direct investment, where you make your investments directly into the exchanges on foreign countries. And doing this, you have to deal with a certain amount of risk. You have a country risk, political landscape of the country, the laws of a foreign country. You have the foreign currency risk. So there are a lot of fluctuations that are going to impact your returns. Currencies being number one. Now, also accounting standards are going to be different between countries, which make it harder to analyze the stocks. And there could be a lot of language barriers as far as reading annual reports and brushing up on news releases. So there are some drawbacks to this. Very direct. Just go to that foreign exchange and buy that company. Some countries, like the United States, will have ADRs, which basically take foreign shares and convert them into American depository receipts, basically saying that the stock's going to trade on the U.S. stock exchange in dollars. The dividends will be paid in dollars. So it eliminates that foreign currency risk and makes it more convenient and lower transaction costs for people to buy and sell foreign stocks on the U.S. Stock exchange. And all the costs are in dollars. Now, let's put the global returns in perspective. Foreign stocks are valued in a similar way to U.S. stocks, but typically U.S. stocks are more highly valued or overvalued than foreign stocks. So if you're looking to get some value stocks, international stocks are more closer to being value plays than U.S. stocks. Now, in each market has their own sort of economic forces that certain parts of the world may do better than other parts of the world. So you just have to kind of take that with a grain of salt. If you're from the U.S. perspective of things, you're going to look at total returns in U.S. dollars as far as capital income and dividends, capital gains or losses, and any changes in the currency exchange rate. So these three things it really could be from any perspective of any country, whatever your current income is in dividends, plus your current gains or losses, plus any changes in the currency rates will be your total return. And equation 5.6 just puts that in a way that it's very similar because we're just adding the returns of current income and capital gains together and adding it to returns of currency exchange rates. So basically the same formula, just putting into slightly different terms. But the key point here is that not only do you have the possibility of making money from the capital gains and dividends like a domestic stock, you have the possibility of also making additional gains on the exchange rates if the exchange rates go into your favor. So this is basically one way you could write the formula. And if you're not in a country that uses living in a place where they uses US dollars, you could put this as total returns in euros if you wanted. So it's really depending on maybe you live in the European Union and you're buying a stock directly in the New York Stock Exchange in dollars. So you could want to look at the beginning value of the foreign currency the ending value of the foreign currency plus the dividend divided by the beginning value of the foreign currency. And then you want to multiply by the exchange rate of the holding period divided by the exchange rate at the beginning of the holding period. So the exchange rate is going to represent the value of the foreign currency in your domestic terms. So it's just an extra layer of complication. So there's a possibility to make a 10% return on the stock, but then have a 10% loss on the exchange, on the foreign currency, basically giving you no return. So from the dollar side, if the US dollar, a stronger US dollar has a negative impact on foreign investments. So just like a stronger euro would have a negative impact on foreign investments as well. So a weaker US dollar will have a positive impact on foreign investments. What that means is if you're from the US and the dollar weakens, if you have your money in euros in a foreign stock and you sell that stock in euros and convert the euros to dollars, you'll have more dollars when those euros convert back to dollars when the dollar is weaker. So it's just really have to know the perspective of what flow the currency is going from which country to which country. Now, over a long time horizon, if you look at, say, the British pound in comparison to the euro or in comparison to the dollar, the British pound has lost a lot of valuation over the past 5, 10, 20 years. So if you had a long-term investment in a British company, much of that return may have been eaten up by the devaluation of the pound. So let's talk about the last couple of slides here. I'll talk about alternative investments. So as far as strategies go, so alternative investment strategies. So common stock, why we like common stock is it's a good storehouse of value. It's a good amount of return long term. So the storehouse of value is really just buying high quality blue chips, non-speculative stocks. Now, if you want to accumulate capital or capital gains, you want to buy growth stocks or income stocks that pay a high dividend, and you want to look at a longer term investment horizon for that accumulation of capital. And when you're talking about sources of income, you want to look at the dependability of dividends and the dependability of the industry to pay dividends. So if you're investing in the oil industry, they may pay good dividends today, but are they going to likely be the dominant fuel source in the future? Now, one of the best investment strategies is the buy and hold. So the buy and hold has proven itself time and time again to be a very superior investment strategy. This is basically, you're going to buy investments and hold them over a long period of time. So if you buy high quality stocks, even if these stocks are at the end of a bull market and you buy them at a very rather high price, if you hold them 10 to 15 to 20 years, in pretty much all instances in the past, those stock prices have gone, even if they go down 50% somewhere in a crash, there's enough time for them to go back and even higher than where they were. So time horizons will protect you from any type of market disturbances or crashes. And you just keep reinvesting the dividends and reinvesting, dollar cost averaging into these stocks. So you basically pick 30 stocks you like and you feel have a good future. You hold them for as long as possible and you continually dollar cost average into those stocks. It could be a possibility every so often that one of the stocks has some massive changes that no longer makes it a good investment, and long term it's not going to be in existence. And those stocks definitely should be sold and reinvested into another quality company. But the buy and hold has been probably studied quite a bit and has proven very successful, but it is boring and it takes a long time. It's just very reliable. Now, current income strategy would just be looking to increase your dividends, buying stocks that are growing dividends, buying stocks that have a stability in dividends to produce a certain income, a reliable income to live off of. So the capital gains are not the goal here. The goal here is to really provide a income in retirement, or in some cases, some people may want to retire early. If they build a good enough portfolio of income-paying stocks, they can retire early on that income that those stocks generate. Quality long-term growth, I'd say, would be closest to my approach in investing, where you want to look for quality stocks that are going to emphasize capital gains in the long term. So you're not really necessarily focused on dividends. You're focused on trading stocks that are going to have good long-term quality growth, like an Amazon, like a Netflix. So hopefully you can buy these stocks when they're smaller and ride them into their growth phases. And you can easily diversify with these stocks, but it's a total return approach where we're looking for this high quality growth as well as potential income once the stocks have reached a phase where they satisfied their growth and now are going to start to pay dividends. So this is really a whole life type of investment strategy. And it's, can be a very attractive because you're getting both the growth of stock price, capital appreciation, and the growth of income. But again, you're looking on stocks that are probably mid caps, have a strong potential to grow into a large cap, and may take, like Amazon, may take 20 years before it really gets there. But you'll be extremely well rewarded. The problem is with this strategy, there's so many extreme ups and downs in some of these stocks. Many people will be tempted to sell them and get scared out of the stock at a certain particular point and miss out on the real bigger longer term gains. Now, currently, a lot of people are pursuing an aggressive stock strategy where they're looking for aggressive collection of stocks that are going to trade in and out of the stocks pretty frequently, holding them for mostly less than a year, and where you're trying to make capital gains. So you're trying to move from one momentum stock to another momentum stock to capitalize on this fairly rapidly increasing stock price. So this is going to really raise the risk and raise the trading costs, consume a lot of time to manage. You generally will have to worry about your positions a great deal. I don't recommend it. But these are people, you're not quite a day trader. A day trader would be someone who would fit into not what we call an aggressive stock management plan, because you still have some decent time horizons and some patience in your portfolio, but you're really just going over those aggressively growing, fast growing stocks. The speculative and short-term trading, this is what you definitely should stay away from. But it's what's the most seductive is like the dark side force of trading, where it's very seductive because, capital gains in certain stocks, when we've had stocks that have gone from $5 a share. If you look at GameStop a while ago, it went from $5 a share to $300 a share, back down to $40 a share, back up to $250 a share. So these are the types of stocks people are looking for, very risky strategy, and with an emphasis on capital gains in the short period. So I want to get in a stock, hold it for 3 months to 6 months, sell it after it's doubled, and move on to the next hot topic stock. So a lot of these investors will speculate on very small cap stocks, tech stocks, biomedical stocks, things that are going to be just very hot one day, and all the investors running into them. Sort of like the cannabis stocks were a few years ago, when those went from nothing to hundreds of dollars and then back down to nothing. Just very speculative, looking for that get rich quick type of scheme. And some people, this would be more in lines of like a day trading. This type of trading in stocks generally always leads to financial ruin. I've never met anybody, I've met quite a number of students who try this aggressive trading strategies only to be completely burnt out by them. And, they could have, 2 or 3 years of really good returns being an aggressively speculative trader, and just takes one day or a couple of weeks to wipe out all those returns you worked so hard on for a few years. So it is something I don't recommend, but, and if you are going to trade in a very speculative nature on very speculative companies, try to keep your total investments a small percentage of your portfolio. So if this is something you feel you must do, maybe only utilize 5% of your total capital in this way to play around with. If, some people treat it almost like a hobby, but just be very careful, because more people have lost money doing this than they've made money. Okay, that's the end of chapter 6. I look forward to talking with you when I cover chapter 7, stock valuations. Take care.